Imagine waking up one day and finding out that the money you invested for your retirement, the nest egg you built over decades, is now completely locked. You can't touch it. You can't sell it. You can't withdraw it. It's just frozen. Not because the market crashed. Not because of some dramatic collapse. But because the door you thought would always be open just quietly closed behind you. Right now, in Canada, $30 billion of people's life savings is trapped in exactly this situation. Doctors, teachers, retirees who thought they were making the safest investment possible are now stuck in what's being called a financial prison. Nearly 40% of Canada's private real estate market has effectively locked its investors inside. No exit, no timeline, just waiting. So stick with me until the end, because what I'm about to show you reveals how an entire investment system can turn from safe haven into no way out, without most people even noticing it was happening. Part 1. The Promise. How safe became a sales pitch. Let's start with the basics. In Canada, there are two main ways regular people invest in real estate. First, there are REITs, real estate investment trusts. Think of these like stocks. You can buy in the morning, sell in the afternoon, and get your money the next day. They trade on the Toronto Stock Exchange. If you want out, you're out. Simple. Second, there are private real estate funds. These don't trade on any exchange. They pool money to buy actual buildings, warehouses, apartments, office towers, mortgages, real, physical stuff, and physical stuff takes time to sell. A warehouse isn't like a stock. You can't just click and cash out. These private funds were marketed as the ultimate safe investment. Beautiful brochures, steady return charts, happy investor testimonials. The pitch. Real estate is stable, low volatility, a safe haven while stocks swing wildly. For years it worked perfectly. Toronto and Vancouver had climbed since the early 2000s. Year after year, prices rose, stocks fluctuate, crypto crashes, gold jumps around. But Canadian real estate? It just goes up, right? So doctors, teachers, retirees put their money in, not day traders. Normal, conservative people who wanted boring and reliable. They'd worked hard, saved diligently. They wanted safety and sleep well at night, and the funds promised liquidity. You can redeem monthly or quarterly. If you need your money, just ask. The stability of buildings with the flexibility of a savings account. Best of both worlds, right? Except there was a massive problem. Liquidity mismatch. Here's what that means. The fund owns buildings that take months or years to sell. But they promised investors could get money back in 30 to 90 days. They're holding something slow while promising something fast. It's like a bank that lends money for 30-year mortgages but tells depositors they can withdraw any time. As long as not too many people ask at once, it works. But when everyone lines up simultaneously, the whole thing collapses. The bank doesn't have the cash. It's locked in those mortgages. That's not panic, that's math. When you promise people can leave whenever they want, but you own things that can't be sold whenever you want, you've built a trap door. In 2025, that trap door opened. Interest rates climbed. Property values fell. Investors started asking for their money back. A trickle became a stream. The stream became a flood. The funds had a choice. Sell buildings at huge losses or close the exit door. They chose the door. Part 2. The lock when the exit door disappeared. Let's talk numbers. The scale of this freeze is staggering. Nearly 40% of Canada's private real estate sector has halted or severely restricted withdrawals. Almost half of an entire industry. The money trapped? About $30 billion. Locked up, gated, frozen, inaccessible. Gating is a rule buried in the fine print that lets managers hit a stop button. All withdrawals halt. You can ask for your money, but the fund says sorry, not right now. And it's legal. It's in the contracts. Buried on page 47 in legal jargon. The fund reserves the right to suspend redemptions in extraordinary circumstances. But how many investors read page 47? Most trusted their advisors. They were told these funds were liquid. They had no reason to think gating would happen to them. Why use gating? To protect remaining investors. If 20 people want out of a 100-person fund, you'd have to sell buildings fast at terrible prices. A $10 million building might fetch $8 million. The 80 people who stayed just lost value. So the fund says, we're closing the exit. Nobody leaves until we can sell properly. Sounds reasonable in theory, devastating in practice. Investors logged in expecting to request withdrawals. Instead, redemption suspended until further notice due to current market conditions. No timeline, no guarantee. Just wait. Be patient. Trust the process. Imagine that feeling. You thought this money was accessible. Maybe you needed it for your daughter's wedding, a medical procedure, retirement expenses. You'd been told this was safe and accessible. Now the rules changed overnight. The door that was always supposed to be open is locked, and you're inside. You own property, but you can't touch your money. Your savings became a waiting room with no clock. You don't know if you'll get your money in 6 months, 2 years, or 5 years. You're just stuck. This is the financial prison. Not rhetorical, structural. The brutal truth. The system didn't fail. It revealed what it always was. Private real estate funds were never truly liquid. They pretended to be as long as not too many people tested the exit. The illusion worked for years. But illusions don't survive stress. Property values in Toronto and Vancouver started falling. Slowly, steadily. People got nervous. When enough people want their money back from something never truly liquid, the door slams shut. That's what 40% of Canada's private real estate investors are living through. The door is closed. The lock is on. Nobody knows when it's opening. Part 3. Romspen, Anatomy of a Freeze. Let's zoom in on one specific example. This is happening to real people in real funds right now. Meet Romspen Investment Corporation, one of Canada's largest private mortgage lenders. Big, established, trusted. The kind of name that made investors feel safe. Romspen manages between $2.5 and $2.8 billion in assets. And right now, Romspen is frozen. Here's what happened. Romspen's model was simple. Lend money to developers and property owners. Borrowers pay interest. Romspen collects and passes it to investors as income. Nice and steady. Then problems started. Property values fell. The buildings Romspen had lent against were worth less. If a borrower defaults, the collateral is worth less too. Interest rates stayed high. Borrowers struggled to repay. Some projects got delayed. Some borrowers stopped paying. Romspen had a cash problem. Money wasn't flowing in, but investors wanted money out. At first, Romspen tried to keep up. Eventually, the math didn't work, not enough cash to pay everyone leaving. So Romspen created a run-off pool. Normally, redemptions are first come, first served. Ask in January. Get paid before someone who asked in June. With a run-off pool, that's gone. Everyone wanting out goes into one big group. The fund pays everyone a little at a time as it slowly sells assets. This is pro rata redemption. If 100 people want out and the fund raises $10 million by selling a building, everyone gets their proportional slice. Nobody gets everything. Everyone gets a tiny piece. Then you wait for another building to sell, maybe 3 months, maybe a year, then another small piece, maybe 5% of what you're owed, then wait again, and again. How long? Years, not weeks, not months, years. Why? Selling commercial real estate takes 6 months minimum, even in good markets. You need a qualified buyer with millions. They inspect, analyze income, secure financing, negotiate. Then lawyers draft contracts, then close. In Canada's current bad market, it takes longer. Few buyers exist. Those who do lowball, 70 cents on the dollar, 60, 50 if they smell desperation. Selling multiple buildings floods the market, driving prices down further. So Romspen investors sit in this pool, watching small payments trickle in, with no idea when they'll get the full amount. Let's make this human. You're a teacher. 20 years putting money into Romspen, planning to retire next year. That money was supposed to cover living expenses until your pension kicked in. Now, you can't retire. Your money's locked. You don't know when you're getting it back. Your retirement isn't delayed months. It's delayed indefinitely. Or you're a doctor. You put savings in for diversification and steady income. Now it's frozen. Can't use it for tuition. Can't use it for emergencies. Just stuck. Life savings turned into long-term IOUs backed by bricks and mortgages that may never sell at full value. And Romspen isn't unique. It's a symptom. When 40% of an industry is frozen, it's not one fund's mistake. It's a structural flaw. Part 4. The structural reset. Why this happened now. Why did this happen now? Why 2025? Back to the core problem. Liquidity mismatch. These funds own illiquid assets, buildings and mortgages that take time to sell. But they made liquid promises. You can get your money back quickly. Illiquid assets plus liquid expectations equals crisis, not if, when. The when was triggered by a structural reset in Canada's biggest real estate markets. In 2025, Toronto and Vancouver hit a wall. Prices started falling, not crashing, just falling, steadily. Why? Interest rates stayed higher longer than expected. Immigration slowed. New construction created supply gluts. Foreign buyers pulled back. Affordability broke. Result: property values dropped. When values drop, investors panic. They ask for their money back. That's exactly what happened. Fund managers faced a brutal choice: sell buildings at steep discounts to pay exiting investors, or freeze everyone and wait for market stabilization. Selling destroys value for remaining investors. Freezing traps everyone but protects remaining value. They chose to freeze. From a pure math perspective, hard to argue they were wrong. But here's the interesting part. Private funds don't show pain like public markets. Own a REIT. You see drops immediately. The stock exchange price falls. 10%, 15, 20. You feel pain in real time. It's transparent, brutal, but honest. Private funds value properties internally. Those internal valuations lag reality by months, sometimes over a year. A building might be worth less today, but the fund doesn't admit it until they try selling or get a new appraisal. So while real value drops, your statement stays stable or shows modest gains. This created false security. Investors in late 2024 and early 2025 saw statements down only 2 or 3%. Public REITs were down 15 or 20%. We're stable, we're safe. But that stability was illusion, delayed reality. The buildings were already worth less. The market had turned. The pain existed. But private funds hadn't updated their books. They valued properties based on appraisals from 6 months or a year ago, when markets were different. When reality hit, when funds actually tried selling and saw real prices, the gap between internal valuation and market price was massive. That's when gating started. Once funds admitted what buildings were actually worth, they couldn't pay back 40% of investors without selling everything at a loss, so they locked the door. This wasn't a surprise, not a black swan. This was a system revealing its true nature under pressure. For years, private real estate funds operated on an assumption. Not everyone would ask for money simultaneously. As long as redemptions were slow and steady, it worked. But systems built on assumptions break when tested. In 2025, the assumption broke. Part 5. Collateral damage when frozen money freezes life. Let's talk about who's trapped in this financial prison. Not hedge fund managers or billionaires, doctors, teachers, retirees, ordinary people who did everything right, saved money, diversified, invested in something marketed as safe and stable. Now they're stuck. Think about the emotional reality. These people wanted security, not risk, not excitement, security. When they retired, or when emergencies hit, they'd have access to their money. Now that security's gone, the money exists in theory, but it's inaccessible. No timeline for when that changes. That's not just financial, that's life. Retirement's delayed. People supposed to stop working next year now must continue because they can't access their funds. Plans cancelled, vacations, home renovations, help with a child's down payment, all frozen, futures on hold, nobody knows for how long. But damage doesn't stop with individual investors. This freeze creates ripple effects across Canada's entire economy. Construction starts have plunged to levels not seen since the great financial crisis of 2008, 2009. A massive drop in new projects. Why? Funds that used to finance projects are hoarding cash. Every dollar might be needed for redemption requests. They're not investing in new buildings, not lending to developers. They're sitting on remaining liquidity, desperately managing redemptions and avoiding fire sale prices. When $30 billion locks up, that's $30 billion not flowing through the economy, not building desperately needed Toronto or Vancouver apartments, not funding infrastructure, not creating construction jobs. The economy slows. Developers can't get financing and shelve projects. Workers don't get hired. Architects, engineers, contractors, suppliers all feel impact. Canada's housing crisis worsens because new supply isn't being built. Then there's contagion risk. Analysts like Edward Dowd warn about the gating factor. When people can't get money from real estate, they panic. They need liquidity, cash. So they sell what they can, can't sell frozen fund units, but can sell stocks, gold, bonds. This is forced selling. People aren't selling what they want. They're selling what they're able to. When many do this simultaneously, it creates volatility in other markets. Stocks drop not from fundamentals, but because people need cash and real estate isn't providing it. This is how one sector's crisis spreads. Quiet, slow, but real, happening right now. The social cost is hard to measure but real. Delayed retirements mean older workers staying longer, fewer openings for younger workers. Cancelled plans mean less spending, less economic activity. Frozen futures mean stress, anxiety, lost trust in the financial system. This isn't dramatic explosion, not Lehman Brothers collapsing overnight. This is slow-motion system failure, hitting people one frozen account at a time. Quiet, structural, devastating. Part 6. The Long Wait. Life inside the financial prison. Where does this leave Canadians in January 2026? Nearly 40% of private real estate fund investors sit in redemption queues. Some lasting months, some years, some completely unknown. Let me explain what a redemption queue feels like. Bank money? Walk in and withdraw today. All of it. Done. Stock. Sell this morning. Money in your account tomorrow afternoon. 2 days for settlement. Simple, fast, predictable. Redemption queue for a private real estate fund? Limbo. A waiting room with no clock and no receptionist who can tell you when you'll be called. You filed your request. Submitted paperwork. The fund acknowledged it. You want your money back. You're in the queue. But no date. No promise. No concrete timeline. Just vague corporate statements. We'll process redemptions as liquidity becomes available. What does that mean? You wait. Hope. Check your account weekly or monthly. Maybe you got 5% this quarter. Maybe next quarter brings another 3%. Maybe. And waiting is worse because market conditions in 2026 aren't improving. Mortgage renewals add more pressure. Thousands of Canadians who locked in low rates years ago now face renewals at much higher rates. Some can't afford new payments, some walk away. Some try selling in a market with rising inventory and few buyers. The real estate market has thin liquidity, a polite way of saying nobody's buying. Inventory piles up, prices are soft. The few transactions happen at discounts. This is the environment private funds try selling buildings into. Brutal. Some funds have started resuming limited payouts. A trickle here and there, but nobody's calling this recovery. Uncertainty remains massive. How long will this last? Nobody knows. Will investors eventually get all their money back? Probably, but at what value and over what timeline is anyone's guess. Here's the hard truth. The financial prison isn't locked by villains. No evil mastermind trapping retirees. The prison is locked by structure, by math, by time. The funds made promises they couldn't keep. Not from lying, but because promises were fundamentally incompatible with owned assets. You can't promise fast liquidity on slow assets. Can't tell people they can leave whenever they want when you own buildings taking years to sell. Can't have it both ways. For years, the system got away with it because not everyone tried leaving at once. But when stress hit, when property values fell, when enough people asked for money back, the illusion shattered. Now 40% of Canada's private real estate investors live with consequences. They're stuck, waiting, learning a painful lesson about the difference between what you're promised and what you actually own. The real danger was never greed, not fraud, not catastrophic market crash. The danger was believing illiquid things could act liquid forever. That belief built the prison. That belief locked the door. Until fundamentals change, until property values stabilize, until buildings can sell at reasonable prices, that door stays closed. Welcome to the financial prison. Population, tens of thousands of Canadians. Exit timeline unknown.